Hello, everybody. Welcome to Chapter 23. We're going to be talking about flexible budgets and standard costs. So, in Chapter 22, we talked about how budgets help a company plan on what they need to produce and how it can help management be held accountable. But what we need to do now is learn how to evaluate and prepare for changes in the budgeting process. So, we're going to go ahead and look at those in this chapter. Here are your learning objectives. Go ahead and pause the video and look at those if you wish. Let's go ahead and start off on talking about preparing a flexible budget and how to interpret a flexible budget's performance report. Flexible budgets versus fixed budgets. Fixed budget is basically predicted a specific level of activity. If you remember in chapter 23, we talked about our budgets and how we expected to sell X number of units. And we based our entire budget on that fixed number of units. What happens if we don't actually sell that number of units? Do we just say, well, oh well, let's keep making our budget and keep doing everything we said we were going to do, even though maybe our sales fall short? No, we don't want to do that. We want to be able to be flexible enough to change what happens so that if a certain level isn't reached, or even if we sell more, we're not going to not make more units because we're not selling, or we're selling more. We're just going to say, oh, sorry, we can't make those sales. So we need to be flexible in our budgets. Here's what a fixed budget performance report is going to look at. What we're going to do is we're going to look at our actual fixed budget, and our fixed budget, and compare it to our actual results. So if you look at this in the month of January 31st, we're seeing that sales actually were 140 units, and our budget was only 100 units. So what's going to happen when we have sales dollars as we look into this difference in number of units we sold? Well, we're going to have a higher sales amount because obviously if we sell more units, in this case 40 additional units, we're going to have an increase in the amount of what we budgeted for sales dollars. And therefore, we're going to look at this and we're going to calculate that we were $25,000 as in a favorable difference than what we budgeted. We got more money than we thought. Well, in a variable costs, we're looking at now, it makes sense that if the more we make, the more it's going to cost us. And in this case, it cost us $18,600. So it's going to look like it's an unfavorable result. We spent more than what we budgeted for. But again, we made more, we sold more. So of course we're going to have a higher variable costs. And that's the real focal point of these budgets, because that's really where we're going to be able to make changes in our, or not make changes, but rather we're going to make our analysis of whether or not that things are favorable or unfavorable. We're going to look at our contribution margin, and of course, if we've sold more, our contribution margin should be higher. Our contribution margin per unit should still be the same, but it'll be higher when we sell more units. And then fixed costs should be fixed costs, but maybe during this time rent increased at a certain point, and thus increased our fixed costs. So we're looking at $400 unfavorable. In many ways, fixed costs are not going to be something we can control. For example, what happens if we have a change in the accounting estimate where we have to change our depreciation expense on an asset because it's no longer going to be as we're not going to have that asset to our advantage for as long as we thought it was, and we're going to have to reverse that. Well, that would be an unfavorable situation. Whoops, I'm sorry, I accidentally clicked the button. I did not mean to do that. There we go. All right. No, I did it twice, I guess. Oh no, I hit back, I guess. Yeah, there we go. Sorry about that. And so as a result of all this, we realized that we have a $6,000 net income more than what we thought we were going to get. And of course, that's favorable. So when we look at this and we compare our actual results to our fixed budget, it's not really telling us the truth. We're not comparing apples to apples. So what we want to do is we want to make a flexible budget so that we can look at different levels of activity. But here's the purpose of the flexible budget. We're going to prepare every budget before the period begins. So that's kind of a given. What it does is it provides a what if. It kind of says, hey, let's look at each of these levels of activity. It's able to make it to where if we're producing or selling at 100 units, it's going to tell us what our budget should be. Then at 150, then at 200, then at 250. That way, as we get closer to the actual number of units, we can adjust it to see what we did versus what we thought we were going to do at that specific production or sales level. So that's what we want to look at as management and be able to see exactly what's happened. And then we're going to look at this after the budget or after the accounting period or the performance period and evaluate how we did. And if there are problems, we can focus on that. Now let's look at the same situation here. I believe it's the same budget on the one we just looked at before. No, it's not because it says 10,000 units now. So this is what we're looking at. We're going to look at it from the variable cost per unit, and we're going to focus that on the number of different variable changes. Look, direct materials, labor, indirect materials, sales commissions, and stuff like that. In theory, sales commissions are going to be the same as a, I gotta be careful how I say this. It's going to be, well, I'm not going to worry about trying. I don't want to confuse you guys, so never mind. Bottom line is you're going to be focusing the most on your direct materials, your direct labor, and your factory overhead for these budget variance reports that we're going to be looking for. If you'll notice our fixed costs, we're pretty much the same across the board, regardless of how many we actually produced. Now, we may have a budget for fixed costs, and we may even be over or under, so it'd be favorable or unfavorable, but our main focus is going to be looking at the variable costs. So in this case, as we look at this, when we looked at our flexible budget here, I'm going to go back here. We have a 12,000 unit sales. Now we found out that we actually did sell 12,000 units. So now we can take our actual results and compare them to our flexible budget under the 12,000 per units and compare how we did. So as we look at our actual results in this situation, we see that our sales was a little higher. We sold them. So what's probably happened is that we don't have necessarily a set price. So what we're able to do is have maybe we had some orders that were smaller. And so we said, okay, but we're going to charge you this higher price for the smaller order. And that's okay. So we made a little bit more money than we thought. But then we're going to look at direct materials. Hey, maybe there was a reason our normal supplier went under, or they had to raise prices or something. So our direct materials was higher than we anticipated. And same with our direct labor, our employees. Maybe we had some younger people quit. We had to train some new people, or some older people may gotten raises. Whatever the case may be, we're going to look and see how we can address that. Then we have our indirect materials. We're going to basically look at our indirect materials as part of our overhead, and then we're going to compare it to our actual results and see that in this case we're 300 favorable. As we look at all this, we're going to look at our total variable costs and see that we are while we're unfavorable, because our sales were higher, we're still on our contribution margin favorable overall. And then as you take out all our fixed costs, we see that the one fixed cost was our insurance. So we know specifically that our insurance expense, likely the premiums went up at some point during the year, so we had to pay a little bit more than we anticipated. But overall, our income is $3,000 more than we anticipated, so our overall income variance is $3,000 favorable. So what are standard costs, and how are we going to use that as useful information? What standard costing does is it allows us to be able to set what we think our costs are going to be per unit. Now, let me kind of give you a little bit of an idea of how this applies in the real world, other than a manufacturing company. What happens is that a management company or somebody is going to do analysis and say, hey, we're going to pull certain variables and see how well and how the standard should be. And how long it takes, how much labor needs to be put in, what direct materials need to be put in, if every time you make the perfect whatever. In my line of work, for when I was an auditor, we had that done. We had a whole bunch of auditors, I want to say about 6 auditors, work on 3 audits at the same time, and they were going to see how they could make it efficient and make it to where we audited more often, more frequently, and more, what's the word I'm looking for? Starts with an E, efficiently. What they did was they pulled a senior auditor who was very good, and a bunch of auditor 2s and auditor 1s who had a lot of experience and did this. So when they did this work and came up with the number of hours it should take to do each of these audits. Now, what that problem is, and this is kind of a real world problem, is if you get your best people in there and then you have that as the standard, what's going to happen is when you get new people or people aren't as good, you're never going to meet that standard. So what they should have done in my audit group is had some new people on there to kind of drain on some of those hours to ask questions. What do I need to do? Because that's a real world situation. But instead, they made it to where basically this audit would run efficiently, smoothly, no hiccups, and how long it would take him to get it done. And then they held us to that standard. It was very challenging to overcome that standard time and to make sure that we were always under reporting or under our hours. And that's kind of what happened. Same thing with standard costing. Let's say we're making cookies. If you get the best cookie maker then there and they make the standard, that might be a good ideal. But as you have turnover in your company and stuff, it might not be a realistic goal to achieve. But that's kind of what standard costing is doing, is it's establishing the baseline or the bar that we need to hit every single time as we're building or manufacturing our items. So it's a preset cost for delivering our products under normal or basically ideal circumstances. And it's also the expectation of a level of performance, a competent level. So when you have new people who are messing up, it doesn't account for that. And then and we use it for direct materials, direct labor, and overhead costs, and those are our standard costs. So as we set standards, we're going to look at our direct materials, direct labor, and our variable overhead. And these are the areas we're going to be looking at: cost and quantity, motion and time, and resources for overhead. So here's our standard cost example. We have our direct materials, direct labor, and our overhead. The standard quantity or hours for each unit to produce is 2.2 pounds for whatever we're making. And then our standard price is $10 per pound for a total direct materials cost of $22 per unit. Same thing with direct materials. It's going to take us 2 direct labor hours to produce it. At $15 per direct labor hour, it's going to be $30 to create this unit. And then we also have, based on our, again, this is the applied overhead, 2 units of direct labor hours at a $5 per direct labor hour rate to give us $10. So under normal or perfect circumstances, we should have, oh, this is pro bat. I guess I missed that. Like we're making baseball bats. It should cost us $62 to make a baseball bat. And that's what we're looking at these things. So let's total up the cost variance here. Cost variances, okay, if it's less, if our actual costs are less than the standard, it's favorable. It means we saved money. We didn't spend as much as we thought. But if the actual costs are greater than the standard cost, it's unfavorable. We spent more than we thought we should. So here's our cost variance analysis. We're going to prepare our reports, analyze the variances, and then ask our questions and answers, and we're going to take action. We're going to look at our reports. What happened? We're going to analyze the variances. How bad were we off by? What happened? What can we do better? How can we fix this? And then take the action to do that. Right, I just kind of went all through all those as I went. So here is our cost variance. This is our overall cost variance of our direct materials. We're taking our actual quantity and we're multiplying it by our actual price to come up with an amount of our actual cost. Then we're doing the same thing with our standard quantity and our standard price. That's our total cost variance. But we're going to break this down into 2 different areas here and evaluate them here in a second. You guys can pause that video and look at that. Here's our direct materials variance. We're going to look at the price variance. When you look and see how we're evaluating this, we're holding the quantity constant to calculate our price variance. And then we're changing our price as we come up with this. So we're going to take our actual price and compare it to our standard price to get our price variance. Conversely, we're going to look at our quantity variance and we're going to change our quantity. We're going to look at our actual quantity and we're going to compare that to our standard quantity. And what that's going to do is tell us how much we should have, or how much we actually used versus how much we did use. And combining all that together will give us our total cost variance like we showed you before. So when we compute our price variance, we're going to look at our actual quantity times our actual price versus our actual quantity times our standard price. Sometimes we don't have those specific information. We're going to have to plug into those formulas that you see on the slide here. All right, so here's your direct materials variance with numbers in there. We're taking 1,800 pounds is what we used and to produce the number of units, which I can't remember. I think it was 12,000 units. And then we had $21 per pound. And so we had a total actual cost of $37,800. Now, when we compare that, comparing the price variance, we're going to look and see what happens if we would got that 1,800 pounds and compared that to our $20 of what we thought we should have paid for it. So our price variance was unfavorable because it was higher than our actual or our standard price. Something happened in the cost of that product that made it go higher. What was it? Well, maybe our supplier made it to where we had to pay more. Maybe it was something else. We don't know. We have to look into it. That's why we take action. Then we're going to look at our quantity variance. What happened when we made these 12,000 units? Okay, we're looking at 1,800 pounds, but we only used 1,750. So maybe we had a lot less scrap. Maybe our scrap wasn't as bad, so we were able to use more of the product that we used. So we used less pounds than we thought we were going to need. So not only, but we were charged for more, but we actually had a favorable, or excuse me, an unfavorable. I'm looking at this backward. I apologize. Our standard quantity was 1,750, and our actual quantity was 1,800. I apologize. I was looking at that backward. Sometimes that can happen, so make sure you're taking the time and processing this. And I'm sorry, I'm seeing now that this is the 3,500 units. I thought they were carrying it over from the other stuff. They usually do, but they're not in this situation. So we actually used more pounds than we were supposed to. So what that means is that we actually had probably more scrap than we anticipated, or we had some scrap when we anticipated zero scrap, and so we had to use more material. So both of these are unfavorable. And when you have two unfavorable variances, you just add them together, and that will equal your total cost material, your direct materials variance, or the total cost variance for the direct materials. If one of those were favorable, then you would net them, and whichever one was higher, like if you had 1,800 favorable versus 1,000 unfavorable, you'd subtract the 1,000 out of the 1,800, you have 1,800 favorable, you'd net it that way. But in this case, they're both unfavorable, so we're going to add them together, and we're $2,800 unfavorable. So then we're going to evaluate our direct materials variance, and we're going to be like, who's responsible for this and why did it happen? It may be just as simple as saying, I don't know, because in this case, it says, I'm not responsible for this unfavorable materials quantity variance. You purchased cheap material, so we had to use more of it. Things weren't as well. Even though we paid the higher price for it, they may have gone cheaply, and so we had to compute and use more of the product because it ran out. And then they said you use too much because your workers are poorly trained and the equipment is poorly maintained. All these are possible ways of looking at it, but these people shouldn't be pointing the finger. They should be looking at the real reason why. And if that's the case, if one of them is wrong, they need to figure that out. Direct labor variance is a little bit easier to understand. I think it's at least I think it is. You're going to look at the rate variance. So your rate is basically the rate of pay. How much are you paying your employees? Well, in this case, your actual cost is $33 versus the standard cost of $32. So you're paying your employees $1 more than you thought you were going to be. Therefore, you're paying these employees with all the direct materials unfavorable variance. You're paying them too much, possibly. So if they're not skilled, then maybe we got to work on that. Maybe we got to train them. Maybe that person's right. But then we look at the efficiency variance, and we looked at it's favorable. Okay, in other words, we used less hours than we thought we needed. Or maybe they're working too fast, and that's what's causing the scrap. So taking both of these variances and looking at them together is going to help you realize that even though we had a good efficiency variance, we've screwed up on our rate variance and we've screwed up on our direct materials variance as a whole. And so even so, as we look at this, as you can see, we had a 1,600 favorable efficiency variance, 1,700 unfavorable. We net them together for a 100 unfavorable total direct labor variance. So we're definitely having to look at these issues and try to figure out why did these happen and how can we make them so that they don't happen in the future? Or can we maintain this efficiency variance working that fast but reduce our errors and scrap? Or maybe what we do is we say, hey, guys, slow it down, take a little extra time, and make sure we don't mess up. That might be okay. That might be okay. All right, so evaluating the direct labor variances, this is kind of what I've talked about. There's one that could be that everybody has kind of a different skill level. If you have lower skills, you're paying them a lower rate, but you're having more issues with the product. If you have high skill, you're gonna have a higher rate, but maybe they're working harder and they have a lot more stuff. You just it's kind of a give and take, and you gotta find out what works for your company. So overhead controllable and volume variances, this is what we want to look at here for our overhead variances. So when we look at our flexible budget at the capacity level, we're looking at 80%. When we're operating and we see that we're operating at 80%, we're saying that we should be able to produce 4,000 units, okay? And then we're looking at all the costs that we assume should be there at a 400 unit production level. So the way we're calculating our overhead standard rate is we're going to take our budgeted overhead at predicted activity level and divide it by the standard allocation based at the predicted activity level. So this is how we do it. Determine allocation based, predicted activity level. Okay, here we go. So we had actual production. We're taking times the standard amount of allocation base and multiplying it by the standard overhead rate. So in this case, our overhead variance, our actual total overhead subtracted minus our standard overhead applied. We're looking at $18,150 was our actual overhead. Our standard was $17,500. So we have an overhead variance of $650. Okay. Oh, and I forgot to say that $20,000 divided by the 2,000 direct labor hours is our $10 per direct labor hour standard price. When we take that and we multiply it by our standard direct labor hour, that's how we're getting our applied overhead, standard overhead applied. So here we go. It's a little bit more better off explained here. We have an 18,150 total, actual total overhead, and it's under what we expected here at our budgeted or flexible overhead at the units produced. We thought it was going to be 19,000, so we have an $850 favorable variance, but our standard overhead applied versus our budgeted overhead at the units produced was $1,500 under. So we're ending up with a $650 under apply, or excuse me, unfavorable overhead variance. So we're going to net those again like we did on the direct labor variance. Our controllable variances, we're looking at it again, comparing these, the total actual overhead, comparing it to the budgeted, and then comparing that to the standard overhead applied. So we're going to have an 850 favorable of controllable variance, 1,500 unfavorable for the volume variance, for 650 under, I keep saying under, unfavorable variance for the overall look at that. Here's our overhead variance report. We're looking at here our flexible budget on the left-hand side, actual results at the units that we produced. So we expected an 80% capacity. Our actual capacity was 3,500, which was 70%. So our actual results are going to be the difference in those two expected levels of production. We're going to calculate all of our overhead variances by taking our actual results and comparing them to our flexible budgets. And you can see we still got that 650 total overhead variance, and the differences in the basically the fixed, or excuse me, the controllable variances versus the volume variances. Here's your variance summary. This will kind of help you give an idea of remembering how to do this. It's a good slide I'd recommend you taking a picture of, keeping close to you, printing it off, or whatever floats your boat. But definitely keep that with you. It'll give you a good way to help calculate things. I'm going to give you guys your word right now, just so that it's not on the end of this one. If I can find my paper, I had it here just a second ago. Here it is. Chapter 23, right? I'm already forgotten. Yes. Okay, so our word today is chocolate. CHOCOLATE. Charlie Hotel Oscar, Charlie Oscar Lima Alpha Tango Echo. Chocolate. 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 That is your word for this video. Sales variances. We can look at this basically the similar way. We got how many units we thought we were going to sell, the ones we actually sold, our selling price compared to what we actually sold them for, and then golf clubs. You could do this to any one of them and look and see how well we did on these. Okay, we sold less golf clubs than we thought, and we sold more golf balls than we thought. Bottom line, computing the variance, we're going to look at our actual versus our flexible budget and compare it to our fixed budget, and then we're going to compare our sales price variance with our sales volume variance. In both products. So we're looking at the first one here under golf balls. We had two favorable variances. Not only was our actual price higher than our budgeted price, but our actual sales was more than our budgeted sales. So we actually had two good situations there. We sold more balls for at a higher price than we thought. But our golf clubs didn't do as good. They were both unfavorable, because we sold less golf clubs and at a lower price than we thought. So that's what we're looking at here. Okay. So people are going to look at this and say, hey, we should stop selling drivers maybe and focus on golf balls. And that's a possibility. You can glean this kind of information as much as you can from from the variances that you calculate. At some point, maybe you realize, hey, and it's not a loser if you're under unfavorable variance, you're still probably making money. You just didn't meet your budgets that you thought you were supposed to make. And that's okay as long as you're still making money. There's no problem there. Compute overhead spending and efficiency variances. I don't think I'm going to go into this. I did before, but no, I'm not going to go into this. This kind of gets into a lot of kind of weeds that I like to avoid. So let's not do that. You guys can look at it if you want. Preparing journal entries. We're going to avoid journal entries on this one too. So let's call it the end of this chapter. This is chapter 23. Remember to put your word into the video verification assignment so that we can make sure that you've seen this video. Good luck on your homework. Let me know if you have any questions, and we'll see you guys in the next videos. Take care.